or part 2 of IAS 12, where we are talking about current tax recognition and measurement. It will be only appropriate to relook again on where current tax comes through. So we learned that the tax expense, especially in the profit and loss account, is made of two important components, which is the current tax and the deferred tax. Let's emphasize again, all income that has been earned in an accounting period is recognized under accrual base of accounting in that period. But not all income is taxable now, or the tax is payable now. For that which is payable now, that's what we call current tax. For that which is payable in the future, that's what is called deferred tax. Under this section, we are mostly focused on the current tax, the determination of it, and the accounting recognition and measurement of current tax. So what is current tax? Current tax is the income tax payable if we're supposed to pay, or refundable if we're supposed to be refunded to ZIMRA based on the taxable profits for the current period, or even sometimes the past period if there is some adjustments that have been found to be necessary. Now, what is the accounting treatment or the recognition? So we should recognize an expense for tax expense, for the tax expense or current tax, because we are paying ZIMRA, so we're supposed to debit tax expense and credit ZIMRA or bank if we are paying. If it's a refund again to us, we are debiting ZIMRA as a receivable, or debiting bank and crediting tax expense. In a lot of other times, we recognize a liability if we have not yet paid that tax in the current period, but it's now due and payable. How do we measure current tax? It is very important to realize that the Zimbabwe tax year of assessment is a calendar year 1 January to 31 December. Now, current tax is measured using the tax rates under the tax laws that have been enacted or substantively enacted. Let's go to the practicalities. Our budget speech for Zimbabwe is normally November. In the budget, on the fiscal policy, the minister normally announces the tax rates and the changes to the tax requirements for various items. That is what we call enactment of tax, or what we call substantively enacted, meaning that that is now law. So, for a 2018 year, the tax rates or requirements were announced in the November budget of 2017. For 2019, which is our current year, the budget was last year in November. And so if one is calculating current tax in 2018, they look at the rates, tax rates and requirements as of November 2017. And if we are doing 2019 tax calculations, we use the rates and requirements as of November 2018. Where an entity has a different year end to the tax year of assessment, so the 28th February, the 30 June, the September year ends, normally they are supposed to have an agreement with ZIMRA, an approval in terms of the rate that they're supposed to use. So in simple terms, as agreed, if we are supposed to pay tax now, we debit our expense and we charge a creditor, ZIMRA, tax payable. On the reversal, if we're supposed to receive income of overpaid ZIMRA, we make ZIMRA a receivable, tax receivable, and we credit our tax expense. So it reduces our tax expense. So, what is current tax in total in terms of measurement? We have to determine our taxable income. How much income is taxable in the current year, multiplied by the current tax rate. So the taxable income is affected by the tax law as well, in terms of which income is taxable, which one is not, how much should be deducted, how much should not be deducted. Also, the budget gives us the rate at which we are supposed to tax. And for normal tax, I think we are currently using the 25.75%, I think, for a number of years, which includes the ads levy. So, let's then quickly have a quick comparison between taxable income and profit before tax. Remember, we said for our current tax, we need our taxable income, we multiply by the current tax rate. So taxable income is not necessarily profit before tax, but there is a relationship. So our profit before tax has got trading income, the gross profit, other income, and operating expense come to profit before tax. So there's an understanding when you calculate taxable income that profit before tax is generally acceptable for the calculation of taxable income. However, there may be some income which are not taxable and some expenses that are not deductible. So we normally then start with the profit before tax. We take away what we call permanent differences. These are incomes that are never taxed in the Income Tax Act. As an example, a capital gain, a profit on disposal of land, is not taxable in our Income Tax Act or normal tax. So that is a permanent difference. But the accountant would have put it as other income, profit on disposal. Also, profit from foreign operations also may be normal, may be permanent difference, in the sense that it cannot be taxed twice under the double tax agreement between Zimbabwe and the respective foreign country. If you look at the non-deductible expenses, we're talking about deductions or expenses that are not in trade, like donations, like fines, and some other losses that happen or expenses that happen which are not linked to the business of the entity. So we take away those from our profit before tax, we adjust. Then we have what we call accrued income, total accrued income. The total accrued income is the total taxable income. However, not all of it will be taxable in the current year. So we then need to go to the deferred tax calculation and see how much of the deferred tax should be, or taxable income should be payable in future, or be brought to be taxed now. So we adjust, we take away that much which will be taxed in future, or we bring in that which was been deferred, which is now taxable, under the plus or minus movement in temporal differences. After we get that, we get what should be taxable under the current year as far as taxable income is concerned. However, we also have got relief from prior tax losses, and ZIMRA allows us to deduct tax losses in the future profits if they were made in the prior. So we also deduct those to come to what we call a taxable income or tax loss, accumulated tax loss. Now, that is our taxable income. Then to get your current tax, you then simply need to take that taxable income here and multiply by the tax rate. The tax rate being the tax rate that has been enacted, that has been pronounced by the minister in the appropriate year. Now, let's zero in a little bit into what are permanent differences. This is income that is never taxable. which is what called non-taxable, or expenses that are never deductible, that is non-deductible by the taxman, that are included in profit before tax by the accountant. Permanent differences, if we look at the non-taxable items or non-taxable income, we are talking about dividends received, which is taxable under a dividend withholding tax with a different rate to the normal trading income. Fair value adjustment of non-current assets, normally some of these are under CGT, or they have been put under the other comprehensive income. So normally these are exempt and taxed. Talk about gain on disposals of especially specified assets and some other assets. Gain on bargain purchase, this is from a group accounting or FRS 3 business combination. The gain on bargain purchase, it's capital in nature. It's also not an income from trade. Gain or loss on loss of control of an asset. So when we sell our subsidiary, we've got a gain or loss on loss of control. That is not of trade. It's much more a capital in nature. Foreign income, taxed with foreign rates, we can't use our local tax rate. So that will be exempted under double taxation agreements, that it doesn't get taxed twice. If you look at expenses, we're talking about donations, we're talking about fines, we're talking about impairment of goodwill, share-based payment expense. Some are exempt, some are deductible in portion, but generally there are some exemptions with that. Loss on disposals, which is a link to the capital gains tax. So generally, as a way of checking, the question is profit before tax equal to taxable income? Or is profit before tax not equal to taxable income? And generally, the answer is that profit before tax is not exactly equal to taxable income, unless there are no permanent differences that could be needed to be adjusted, and also tax losses and so forth. So if we look at our component of tax expense as we learned, we are focusing mostly in this case in our normal corporate tax, current tax, which is the taxable income times the current tax rate. So from a study point of view, quite a lot of marks or work is on calculation of the taxable income and using the appropriate current tax rate. So that's our first focus, the normal tax, the current income. So when you get your taxable income, you debit your tax expense, you credit the similar with corporate tax payable. Right. If we go to our module, we need to go first as a simple way to go to example 20. Under example 20, we say we've got a simple example where the profit before tax for the year is 400,000. There are no temporary differences and there are also no permanent differences. In other words, in this case, our taxable income and our profit before tax are exactly the same. And to calculate current tax, we then therefore take 400,000 times 25.75%, we get 103,000, which is part of our. So if you follow the disclosures and the accounting and under example 20, you can see how simple this is. So example 20, 21 and 22 are built in a way that would allow you to see the differing procedures or issues that happens when you are dealing with current tax. As an example, if you go to example 21 talks to profit before tax of 400, but it includes no permanent differences. However, it introduces temporary differences, which we're going to cover under deferred tax. If you look at example 22 refers that the profit before tax for the year is 400,000. The profit includes the following amongst others: 20,000 local dividend. So automatically, as a student, when you see 20,000 local dividend, local dividends are exempt but they are in the profit for, so that's a permanent difference, non-taxable income. 500 meals expense, which are not deductible. So in other words, that's a non-deductible expense. And a zero tax penalty, it means that that's not in professional income, that's also a permanent difference. So you should be able to identify within a scenario permanent differences. Example 22 there also is very comprehensive because it also then have temporal differences and some other issues. So from example 21, 22, 23, you should be able to see how, especially after learning deferred tax in part 3. So I've just discussed to you the impact of example 21 and 22 and how they affect. So it's before any test you need to go and study and work through example 20, 21, 22. See how you calculate, you disclose your tax expense, both current and deferred, and all the way. Now, what is the impact of assessed losses on current tax? It's we're allowed to deduct the tax losses at the end, and that's how it simply affects us. The tax loss brought forward, that's how it simply affects us. Now, how is current tax paid to Zimra? Current tax is paid through what we call quarterly payment dates, or QPDs, through the provisional payment of corporate tax. So QPDs provides liquidity to government throughout the year. Companies pay their tax using QPDs as communicated by Zimra, which is normally 25th of March. They pay 10% of the estimated total tax for the year. So tax is actually paid in advance on the 20th of March, the 20th of June, 20th of September, and 20th of December, based on those percentages. Now, when you look at those quarterly payments, provisional tax, at the end of the year, an entity should produce an actual statement of comprehensive income and submit it to Zimra. And normally that should be on or before 30 April of the year. And this is what we call a self-assessment return, and which should be compared with the QPD payments that have been made to see whether we've got an over or under a recovery or under payment. I'll quickly give you a scenario just to show how the calculation of QPDs are done. So if an entity estimate that its taxable income will be 400,000 for the year, and that this amount is constant, remains constant, it is properly and accurately calculated. An entity then calculates its first QPD being 400,000 times 25%. That's the total. Of that 400, 10% of it is payable in the first quarter, 25%, and it goes like that. This is not always the case that the estimated taxable income is constant. So when it's not constant, we might actually have to go through a 3-step procedure. First of all, reassess the estimated taxable profit at the end of the last quarter. So you reconsider, are we still expecting the same profits? If the estimated taxable profits changes, you need to recalculate the total estimated tax based on the cumulative percentage. So now use this new estimated taxable profit, multiply by the total cumulative. So if it's in the second quarter, you're supposed to pay 10% in the first and 25%. So your total cumulative should be 35. So 35% of the new estimated profit, and that you get the correct estimated profit as of the second quarter. But your payment under step number 3 is to deduct the payment that was paid in the last quarter and then just pay the difference, which will be a correct payment. There is no need to go and adjust the previous QPD. So an example given here, in the initial quarter we estimated that QPD, the estimated annual profit was 400,000. So we calculate on 103, our 10% was 10,300. But when you look into the second quarter, our estimated now is different. It's now 410. So we now calculate 410 times 35%, which is the sum of 25 plus 10%. And we get our total tax. We multiply that so we multiply by, we call it 410 times 25% times 35%. We then subtract what we paid in the previous quarter. What it means that the tax payable on the second QPD is now correct based on the current estimated profit and the level of QPDs, which is 35% as of the second quarter. And then you go on like that. Now, the fact that we have to finish off the tax after year end, which is an entity with a December year end, 31 December year end, has to finalize and submit its tax return by 30th of April or on or before. It has actually been paying tax ahead using the QPDs. There may be a disparity or a difference. However, that difference is recognized in the next period in which the submission is done. And first of all, we need to assess or analyze the cause of the difference. If the cause is a difference between the taxman and the accountant due to tax law or practice, a little bit of difference in terms of interpretation, that could be easily classified as a change in estimate. Whereas if it's because of inappropriate calculation, inappropriate application of tax law by the entity, that could be called a prior period error. So the accounting for the difference depends on the classification, either as a change in estimate or a prior period error. If it is a change in estimate, we need to go and readjust. And please look at example 23 in the module to see how a change in estimate is dealt with where there is. But if it's a prior period error, you actually then need to go to IAS 8 and do your restatement of prior period error appropriately as per requirements of IAS 8. Note that normally the final payment may include other things. Those other things like penalty and interest on overdue tax should be recognized separately. The interest on outstanding tax should be finance cost. Penalties should be recognized separately as other expenses, right? And compared with the final payment, the difference is what we call the over or under. Okay, and example 23 shows that in a perfect way. So the tax expense or the tax expense include the current tax as shown, but here we also have shown you how the prior year current tax also arises. If there are any questions or areas that you are not clear, please bring them to class and also go and see your tutor. I hope you've gotten to understand how to calculate or how to deal with current tax. The second part is the calculation of capital gains tax, which we will pick in the next session.